Hello, everyone, and welcome to today's training, Top 10 Fiscal Challenges in a Community Action Program. My name is John Hemming. I'm a partner with Wipfli CPAs and Consultants. I've been in public accounting for 25 years, and the majority of that time I've been focusing on nonprofit organizations, specifically grant-funded nonprofit organizations. Before we get started today, we do have a couple of administrative things. Please do not record any of this training. So those of you with smart devices or any type of recording devices, recording of this training is prohibited. The materials, these are incomplete without the comments of yours truly. The materials are informational and educational in nature and represent the speaker's own views. These materials are for the purchasing agency's use only and not for distribution outside of the agency or publishing on a public website. These training materials were created in collaboration with Wipfli and the National Association of Community Action Agencies. Any opinion, findings, and conclusions or recommendations expressed in this material are those of the authors and do not necessarily reflect the views of the U.S. Department of Health and Human Services, Administration for Children and Families. All right, top 10 fiscal challenges. Certainly we face challenges on a daily basis. What we've done here in this particular training, or what we'll go over in the next hour here, are some of the ones we see most common. As I mentioned, I've been in the public accounting arena for 25 years and seen a lot in my time. And certainly agencies do have areas where they do have challenges. And the first one that comes to mind is recognizing grant revenue. And this one has had some more recent changes with some new accounting standards and identifying how we recognize our revenue. There's a new accounting standard that'll be effective for most organizations moving forward now called revenue recognition. And within that, you do need to recognize what type of grant revenue do you have. Grants can either be exchange transactions or a contribution to your organization, and being able to understand the difference between those two is vital, especially now with that new revenue recognition standard. So let's define an exchange transaction. An exchange transaction is a reciprocal transfer between two entities that results in one of the entities acquiring assets or services or satisfying liabilities by surrendering other assets or services or incurring other obligations. I think a good example of an exchange transaction is something that we probably do on a regular basis. You go to a store and you give that store, maybe this is a Best Buy or some type of TV store, you give them $1,000 in cash. What do they give you for that $1,000? You certainly get to take a TV home. That would be an example of an exchange transaction. Contributions. Contributions are transactions in which one entity, acting other than as an owner, makes an unconditional voluntary transfer to another entity without directly receiving equal value in the exchange. So important to decipher between the two, an exchange transaction or a contribution. Here's a little blurb from the AICPA Nonprofit Audit and Accounting Guide. Other kinds of government transfers, sometimes referred to as grants, awards, or appropriations, have unique characteristics that may make it difficult to determine whether they are contributions or exchange transactions. So you need to look at all of your grant revenue streams and make that determination. Do I have a contribution or do I have an exchange transaction? Depending on the facts and circumstances, some indicators may be more significant than others. However, no single indicator is a determinative of the classification of a particular transaction. The next big fiscal item that I typically see is intercompany activities. And intercompany activities happens quite a bit in nonprofit organizations. A couple of things to keep in mind as you are dealing with intercompany transactions. The first one there is extremely important. You can't make money off of yourself. You don't want to double count. You want to make sure you're eliminating. There's no way when you have an intercompany transaction, if you're doing it right, that somehow you produce a profit. So the two bullet points there are extremely important to keep in mind when you talk about intercompany activity. A couple of examples that we'll see, and we'll get into a financial statement here in a second. Rent of facilities to your programs. You want to make sure that as we charge our various programs rental costs, that we're not doubling up or making money off of that rent. And the same thing holds true for cost pools, whether it be your management or your fiscal staff, or a lot of times in the costing method that you may have, you develop cost pools and you've put monies in those pools and you've allocated to them to the various programs. You want to make sure that as you've allocated those costs to those various programs that you haven't doubled up anything from a revenue and expense perspective. So facilities, looking at a facility. If a facility is owned by the organization and recorded in a separate fund in the accounting system, then it is an intercompany account. And as we know, when we're doing our accounting for a grant-funded agency, we do have multiple funds. We have multiple funds because we've set them up to track the individual grants that we receive. And so a transaction from a rent perspective that affects a particular grant, you probably are also affecting, or you will affect, your general fund or your corporate fund account as you account for that. If the facility is owned by a wholly owned subsidiary, it is also an intercompany account. So that's something to keep in mind as well. I see some clients sometimes that will have their building that they occupy in a separate entity, but that separate entity is a wholly owned subsidiary. They move it out into that separate entity to basically limit liability on that whole building itself. Any subsidiary transactions that occur related to that from a rental perspective is an intercompany transaction, and one that you do want to account for to make sure you eliminate, do the proper elimination so that you're not doubled up. Either of those cases, the only time you're going to record revenues and expenses, you're going to eliminate those unless that space is occupied or rented to a third party. Then you can record that rent. So grant-funded nonprofit regulations as it relates to rental costs. So rental costs under less than arm's length leases are allowable only up to the amount as explained in paragraph B of this section. So they are allowable, and when we say less than arm's length, what we're saying there is we have ownership in that property. It's less than arm's length. It's not a third party. Somehow we are related in that transaction, whether it's in your own funds within your own entity or if you have a subsidiary. For this purpose, a less than arm's length lease is one under which one party to the lease agreement is able to control or substantially influence the actions of the other. Such leases include, but are not limited to, those between divisions of the non-federal entity. When we say divisions, think of those as funds. The non-federal entity under common control through common officers, directors, or members. This would be maybe a sister organization, but it's run by the same board. So in essence, you should be consolidating them in essence, treating them as a subsidiary. Or 3, the non-federal entity and a director, trustee, officer, or key employee of the entity or an immediate family member, either directly through corporations, trusts, or similar agreements in which they hold a controlling interest. For example, the non-federal entity may establish a separate corporation for the sole purpose of owning property and leasing it back to the non-federal entity. just like we had mentioned there previously. So if you look at this, and obviously we're focusing on the two columns that are highlighted, the admin building and the building eliminations. Under the admin building fund, we are recording the $300,448 of rental income. Now that rental income is generated by charging rental costs to the various programs that we're operating. And you want to make sure when it's all said and done, you are eliminating that so you're not making profit off of rent that you're charging to the various grants or programs. That would be an intercompany transaction. So you see here, when you look at the total revenues and total expenses, from an admin building perspective, we have $300,448 of admin building revenue. We have the same amount of expense, so the revenues over expenditures equals 0. And then we do the elimination. We obviously back off that rental income and those rental costs, and it ends up being 0. We end up with that elimination. Equipment purchased with federal grant funds. And this one is interesting from a couple of different perspectives. In the past, and what we mean by in the past is this was before the new nonprofit reporting standards were in effect. In the past, there was 2 ways to record equipment purchased with federal grant funds. You could show it as an unrestricted net asset, or you could adopt a policy where you apply time restrictions, in which case, if you adopted that policy, you would show the net book value of grant-funded equipment that was purchased as a temporarily restricted item. And generally accepted accounting principles stayed silent on that under the old rules, and so either method was acceptable. Now, however, under the new accounting standards, and they are actually in effect for all entities now, you no longer have that option of doing it in either of the 2 categories. Now the nonprofit or the equipment purchase with federal grant funds has to be shown in net assets without restrictions. Even if in some cases states may hold title to the equipment, which is material, that does not apply. You still want to be recording those grant funded purchases. Another thing to keep in mind as it relates to grant funds or equipment purchased with grant funds, understand the difference between what the funding source is requiring you to do versus generally accepted accounting principles. The funding source will give you approval to purchase a fixed asset item. Let's call it a bus. Let's say it's $30,000. The funding source will tell you that you need to go purchase a bus and we're going to reimburse you $30,000, and you're going to record that as an expense item or a cost that has been incurred to the grant. And as you do your reporting to that funding source, you're going to report $30,000 of grant revenue, $30,000 of expense. It ends up being a wash, so no change in net assets. That's what the funding source will ask you to report to. Generally accepted accounting principles will tell you that you purchased a bus and that bus has a useful life beyond 1 year. And as a result, you're going to capitalize that bus and then depreciate it. So you take the $30,000 of expense and you remove it in a GAAP adjustment journal entry. You remove it from expense and you put it on your statement of financial position. You capitalize it as a property and equipment item. And then you start recording depreciation. So if that bus that we got for $30,000, we might have a useful life of 10 years on it. We start to take expense or depreciation expense on that bus, and we'll do the calculation of what that is and take that expense over 10 years. So a couple of things there related to equipment purchase with grant funds. A couple of FASB announcements here. Gifts of long-lived assets received without stipulations about how long the donated asset must be used shall be reported as restricted support if it's in the not-for-profit's accounting policy to apply time restrictions. So again, that's the old one where applying a time restriction, you could record it as temporarily restricted net assets. Not-for-profits that adopt a policy of applying time restrictions also shall imply a time restriction on long-lived assets acquired with gifts or cash or other assets restricted for those acquisitions. In the absence of that policy or other donor-imposed restrictions on the use of those assets, gifts, or long-lived assets shall be reported as unrestricted support. So here we have an example, again, focusing on the grant-funded property and equipment. We have equipment rental maintenance of $160,000. We have other of $30,000. Here's where, for GAAP purposes, financial statement purposes, we are actually showing a positive revenues over expenses, because what we're showing here is that we purchased fixed assets or capital assets in the amount of $160,000. We're removing that from expense, and we're actually, the $30,000 would be what the depreciation expense would be. So when we capitalize the $160,000, we're actually creating $160,000 of a positive change in net assets. And then when we record the depreciation on the asset that we're capitalizing, we're actually reducing it by that $30,000. So when it's all said and done, this particular transaction that occurred during this year, we end up with a positive revenues over expenditures of $130,000. Self-funded insurance, seen this a variety of ways. Let's talk about it a little bit, because there are a couple of ways to treat it. Both ways are acceptable, but they do have an effect on how you're going to report it, depending on how you present that and how you interpret self-funded insurance. So, insurance and indemnification under the cost principles, contributions to a reserve for a certain self-insurance programs, including workers' compensation, unemployment compensation, and severance pay, are allowable subject to the following provisions. So basically we're saying we can have a self-insurance program. Under the certain provisions, those provisions are the type of coverage and the extent of the coverage and the rates of the premiums would have been allowed had insurance, including reinsurance, been purchased to cover the risks. So basically what it's saying is you're allowed to do self-insurance to the extent that you would have had to purchase regular insurance had you not self-insured. However, provision for known or reasonably estimated self-insured liabilities, which do not become payable for more than 1 year after the provision is made, must not exceed the discounted present value of the liability. The rate used for discounting the liability must be determined by giving consideration to such factors as the non-federal entity's settlement rate for those liabilities and its investment rate in return. It's a lot of information there. Basically, what that's saying is you can self-insure and you can build up a reserve. So in essence, you are charging the grants a certain dollar amount for the self-insurance. What this is saying there, though, is the claims on those insurance, 1 year's worth of claims, cannot exceed what you've either recorded as a liability or deferred revenue, or what you've shown as net assets without donor restrictions. We'll get into that in a second here. We'll present that in a second. Earnings or investment income on the reserve must be credited to those reserves, is the other provision. So as we look and continue on those provisions, contributions to reserves must be based on sound actuarial principles using historical experience, reasonable assumptions. Reserve levels must be analyzed and updated at least biannually. for each major risk being insured and take into account any reinsurance and so on and so forth. Reserve levels in excess of the amounts based on the above must be identified and justified in the cost allocation plan or indirect cost rate proposal. Another paragraph from the AICPA Nonprofit Audit and Accounting Guide: unrestricted fund balances that have been designated by governing bodies for specific purposes, and we see this quite often. For those agencies that do self-insure and they do show the reserves in a net asset category, the net asset without donor restrictions category, for those in that net asset category, sometimes you will see where they board designate or they show the self-insurance reserve funds. So you can see a board designated for a quasi-endowment, funds functioning as endowment, funds for long-term investment, and self-insurance reserve funds for future development funds. Those should be classified as net assets without donor restrictions. So let's look at this. We have a self-insurance pool balance sheet. Option A and option B, we have obviously cash, AR, and our investments, total assets 489,903. Option A shows here where we would have reserves as it relates to our self-insurance, shown in the net assets without donor restriction column. You can see that by the $425,400 in the net assets without donor restrictions. Or you can have option B where we don't have it fall to the bottom line, but we show it as a deferred revenue item. And you see under deferred revenue, you see under option B, you have that same amount, $425,400. In the end, you end up at the same total liabilities and net assets utilizing either option. However, one of them shows up as a liability, the other one shown in your net assets. When you do have it down in your net assets, that's why you'll see on the previous slide where you see some board designated or the presentation where they've broken that out separately, because you do want the reader of the financial statements to know if you have self-insurance reserves in your net assets, you want to know what those amounts are. So as we look at this, we have a self-insurance pool, and in this area, we have shown where we have charged the grants, and we've ended up with revenues of $1,780,189. We've had actual claims of $1,354,789. Now, when you do the revenue versus expense calculation, you end up with a revenue over expenditures of $425,400. Nothing wrong with this, but we do need to factor in what needs to be eliminated. You want to eliminate this. Gets into an intercompany allocation. We've charged the grants that $1.7 million, right? So we've requested the reimbursement from it. We received it from the grants, but we actually haven't received $1.7 million. You need to offset the claims against that. So the claims being the $1.3 million. So there is an elimination calculation there that you do want to do as it relates to the claims. You would do that under option A. So when it's all said and done, you'd end up with $425,000 added to your self-insurance pool or your reserves. Now, if you did option B, where you're just showing it in deferred revenue, you actually wouldn't have any revenue or expense transactions as it relates to this. You're running everything through that deferred revenue account because you're showing it as a liability. Nothing falls to the bottom line under option B. Year-end supplies, service, equipment purchases. I get a lot of questions surrounding this, and you really need to have some clarity and understand what you're doing towards the end of the year, because there is different methodologies for how you would record something from a grant funded perspective as well as a gap perspective. Similar to the equipment purchased with grant funds, year-end supply purchases potentially have an issue of being different. So, as an example, our organization has a December year-end, December 31st, 2019, and our largest grant also ends on December 31st. How do we record liabilities for supplies ordered on December 31st that we have not yet received? So we've ordered some supplies. We know that we're going to get them, but we haven't received them. We don't have an invoice yet. How do we record that from a liability standpoint? Well, uniform guidance will talk about obligations. And 200.71 talks obligations. When used in connection with a non-federal entity's utilization of funds under a federal award, meaning we're incurring costs that we are charging to one of our grant awards. Obligations means orders placed for property and services, contracts, and subawards made, and similar transactions during a given period that require payment by the non-federal entity during the same or future period. So really what this is saying is, if at December 31st I go and I purchase supplies under uniform guidance, that is an obligation. It's classified as an obligation. Now this is from the Early Childhood Learning website, identifying various obligations. So you can have obligations for services by an employee of the grantor, and when would that obligation be made? On the date the services are performed. Services by a contractor, the obligation is made on the date the grantee makes a binding written commitment to obtain the services or work. Public utility services, travel, acquisition of real property, rental of real property, acquisition of supplies, equipment, and other personal property. The obligation is made on the date that the grantee orders from the vendor, not receives an invoice, orders from the vendor, or on the date the grantee makes a binding written commitment for the property. So when we're talking about supplies and we have requested or ordered something and we just have not received it, we do have an obligation. We do have a cost that we can record against our grant award related to it, because we've effectively created a contract or we have a binding agreement with a vendor when we order supplies. And there's other obligations here. As I mentioned, you have the real property, you have audit services. I think this is a real handy spreadsheet to show you or identify when an obligation is actually made. And again, this becomes important at the end of the year, at the end of your grant award. If you haven't totally spent it out and you are going to purchase supplies for that award, you got to make sure that you have an obligation in order to effectively charge that against the grant. Now, that is for funding source purposes. So this is for an obligation for funding source. Uniform guidance relates to the grant awards themselves. But again, we are dealing with two different things. We are dealing with the funding source reporting, and we are dealing with gap reporting. When we're dealing with funding source reporting, we are dealing with closeouts that we send to the funding source, or quarterly statements, or any reporting that we do to the funding source. The funding source, take a Head Start grant award, that's a cost reimbursement type grant. When it's all said and done and you're doing your reports and you're doing your closeout reports for a Head Start grant award, what the funding source is going to want to see is that you had grant revenue and you had grant expenses, and that those two numbers hopefully match with one another. Meaning, if I got $1 million Head Start grant award and I've done everything, I've spent the grant out, I've accomplished what I needed to do from a grant award perspective. At the end, when I'm doing a closeout, that closeout should say grant revenue of $1 million, grant expenses of $1 million. And when you do that, you would include any obligations. So if you had $20,000 of supplies that you purchased or that you ordered on the last day of the year, that ordering, again, under this makes that an obligation and something that can be charged to the grant. So that extra $20,000, not extra, but that $20,000 of supplies you ordered at the end of the year, hopefully is that $20,000 that you needed to spend that whole $1 million. GAAP, however, generally accepted accounting principles, will tell you something different. Remember that generally accepted accounting principles and funding source regulations are not always the same. Under generally accepted accounting principles, we recognize their expense and payable at the same time the seller recognizes the revenue and a receivable. Therefore, we need to look to the revenue recognition standards to determine when a sale has taken place. Mentioned earlier about the grant revenue recognition, it also applies here. So under this new standard, ASC 606, that's the new revenue recognition standard, an entity shall account for a contract with a customer that when all of the following criteria are met. So we have A through E here. The parties to the contract have approved the contract in writing, orally, or in accordance with the customary business practices and are committed to performing those respective obligations. The entity can identify each party's rights regarding the goods or services to be transferred. The entity can identify the payment terms for the goods or services to be transferred. The contract has commercial substance. It is probable that the entity will collect substantially all of the consideration to which it will be entitled in exchange for the goods or services that will be transferred to the customer. So that's under the new accounting revenue recognition standard. Also, an entity should be determined when it has satisfied its performance obligation to transfer a product by evaluating when a customer obtains control of that product. For some contracts, control is transferred either when the product is delivered to the customer site or when the product is shipped, depending on the terms of the contract. Think of this for those accounting majors, or at least those that took a few accounting classes. Remember when we had free on board shipping point or free on board destination? Think of that in the same manner. So looking into this and getting back to our supplies, this revenue recognition requires you to look at things a little bit differently. And the second part of the revenue recognition on this slide, a couple of key words here is when an entity needs to determine when the performance obligation has been satisfied. So if I order supplies at the end of the year, has my performance obligation been satisfied? Well, maybe, maybe not. It depends on when you think they have satisfied that performance obligation. And as it mentions there in red, control is either transferred, or think of this in terms of satisfying the performance obligation, happens when it's when control is transferred either when the product is delivered to the customer's site or when the product is shipped. If I'm ordering at year end, I haven't satisfied the performance obligation to either one of those claims. I have just ordered it. Unless it gets shipped that same day or that at that same time or instantaneously, I haven't satisfied the performance obligation. If you order it a week in advance and you know that it has been shipped and it's en route, you need to make this assessment. Why am I getting at all of this? Is because if you have a purchase of supplies at year end where the performance obligation has not been satisfied, you have to treat that as what we call an encumbrance. And encumbrances are different than GAAP. Encumbrances, we want to show it just like we would to the funding source, in that I have a $20,000 obligation to pay. I am going to tell the funding source I've encumbered $20,000 worth of expenses. Encumbrances not being GAAP, you have to eliminate those encumbrances. That's why purchases at year end can be very confusing. And obviously you see that by this person pulling their hair out. So how do you do that? When we look at this, we are doing a GAAP adjustment fund. We are eliminating grant revenue of $120,000. Why are we eliminating that? It's because we haven't satisfied our performance obligation. Under the new revenue recognition, because we haven't satisfied that performance obligation, we have to treat that as an encumbrance and, in essence, remove that. Back in 2018, that revenue recognition wasn't in there. We showed the grant revenue of $80,000 and the expense of $80,000. Either way, we do not have any amount that falls to the bottom line there. So year-end purchases can be very tricky, and year-end service and equipment contracts, obviously similar to supplies, service and equipment liability and expense and asset recognition is based on the terms of the contract. So you need to look at the contract itself for when do we record that expense and recognize the asset. Services for renovations, consulting, etc., are not generally recognized until the work is performed or a portion of the work is performed. Equipment sometimes is a liability, especially for custom order items such as delivery trucks or buses. What if we order a bus, don't have the bus yet, and did not pay for the bus, but would determine we do have a liability to record? How do we record that? Well, certainly if you're recording a liability, you're obviously going to want to have some type of asset that you're offsetting that liability if you have not had that yet. In-kind contributions. In-kind contributions are one that is primarily, we see it most often in our Head Start grant award. And under the FASB 958-605, contributions of services shall be recognized if the services received meet any of the following criteria. They create or enhance a non-financial asset, or their required specialized skills are provided by individuals possessing those skills and would typically need to be purchased if not provided by donation. Services required specialized skills are provided by accountants, architects, carpenters, so on and so forth. Contributed services and promises to give services that do not meet these criteria shall not be recognized. Now, these definitions are for GAAP purposes. Once again, we have a situation where what we report to the funding source is potentially different than what we report on our generally accepted accounting principle financial statements. For funding source purposes, in-kind is tracked in two ways. You have in-kind that could be, the makeup of your in-kind could be space in-kind. In space is certainly something that we would record. We would also record any volunteer time. Now that volunteer time can come in a variety of ways. It could come from people with specialized skills. So your doctors, nurses, any type of skilled labor. But the majority of our volunteers come for in-kind from parents donating their time in the classroom. All of that, you total up all of that, and you hope that you're meeting your in-kind requirement, which is 20% of the grant award. So when you report to the funding source, you're taking that space in-kind, any supplies or materials that have been donated that's in-kind. You're taking those specialized skills, those volunteer contributions, And you're also taking those volunteers from the parents that help in the classroom. You take their hours, you come up with some kind of rate, and you come up with a dollar amount. And revenue in kind almost always equals in kind expense. In kind revenue almost always equals in kind expense. So that you report to the funding source and you report the entire amount. For GAAP purposes, it is different. For GAAP purposes, you would record that space in kind. You'd also record that specialized skilled in kind. But the contributions that does not have specialized skill, i.e. the parents that volunteer their time in the classroom, that is not considered GAAP in kind. So that gets eliminated or backed out of your in kind revenue and in kind expense on your statement of activities. And it should get disclosed in your in kind contribution footnote in your notes to the financial statements. So once again, we have something that is different from a funding source reporting perspective versus a generally accepted accounting principles reporting perspective. So understanding the difference with in-kind, more definitions here. Gifts in kind that can be used or sold shall be measured at fair value. You do come up with some type of fair value measurement in terms of how you value any materials that have been donated to the Head Start classroom or any type of in-kind calculation. In determining the fair value, entities should consider the quality and quantity of the gifts, as well as any applicable discounts that would have been received by the entity, including discounts based on the quantity if the assets had been acquired in an exchange transaction. Example related to this, let's say that I donated 10 Commodore 64s. For those listening that are my age, late 40s, you know what a Commodore 64 is. It's the very first, or one of the very first home computers. We know how fast the computer industry is in terms of obsolescence. Today, if I donated 10 Commodore 64s to a Head Start agency, they might use them as paperweights. There's basically no value to them at all. So then when we're determining value, we need to take that into consideration. Is there any value in the gift? If I would have donated 10 Commodore 64s back in 1980, there certainly would have been a value back then. So keep that in mind. The last one there, fair value would generally not increase when a gift in kind is passed from one entity to another. However, fair value could increase if an entity adds value to the gift, such as by cleaning or packaging the gift. Any increases should be evaluated to determine whether the entity did, in fact, add fair value to the assets. Basically, what we're saying here is when you're recording your in-kind, make sure it's reasonable, that it can be valued, that it can be substantiated based on some type of support that you have for it. All right, so 7, 8, 9, and 10, and a couple of more after that. These are probably onesies, twosies, probably not as big as 1 through 6, or not as much commentary on 1 through 6, but we certainly see them quite a bit. It's important to be able to understand how we're reading a financial statement. So if we look at this and we go over to the right-hand column, and we see our revenues and expenditures at $29,152. We think, okay, did I have a good year or did I have a bad year? Well, you need to be able to look and understand what's going on in the various funds that you're doing, that you have. So grant 1, 2, 3, 4, right before the total, those grants, you can see the revenues always equal the expenses. What's that telling you? Those are cost reimbursement type grants. And as a result, you would expect to see no change in our revenues over expenses. Then we go to the left-hand column and we say, all right, we have a corporate account or an unrestricted account. or we should say without donor restrictions account. We have a performance-based contract, then we have fundraising, and then we have grant-funded equipment. As we look at those, we look at our corporate account. We generated just less than $200,000 of contributions and miscellaneous income. We had to transfer those monies, $200,000 of it, over to Grant 3. That $200,000 transfer, what is that saying? Really what that's saying is I overspent grant number 3. I had to transfer monies over from corporate to the tune of $200,000. So all of those contributions and miscellaneous revenues that we generated, we basically generated those to cover our grant expense in Grant 3 that we overspent. On our performance-based contract, did we make any money on a performance-based or fee-for-service type contract? We had revenues of $380,000, but we had expenses of $422,000. So in the end, we lost $42,000. Couple of situations there, things don't look all that well. Now, in our fundraising efforts, we were able to generate some positive dollars or some positive revenues over expenses, just over $14,000. Then we get into our grant-funded equipment. Remember the change in grant-funded equipment? Funding source will tell you to expense. Generally accepted accounting principles tells you to capitalize. Well, in this situation, because of that transaction, we generated $130,000 worth of profit. So when we look at the $29,152 in the bottom lower right-hand corner, anytime you have revenues over expenses, you think that's a positive. As you decipher this, as you look into it, as you understand how to read an income statement, we didn't make $29,152. We did on paper. But in reality, how did we get there? Well, we created $130,000 of profit or positive change in revenues over expenses by capitalizing a capital asset purchase. We ended up losing $72,000 in our corporate account. A big portion of that loss is because we had to cover losses in an overspent grant, i.e. Grant 3. Our performance-based contract, we have fee-for-service or performance-based contracts with the hopes of being efficient enough so that we can generate positive, I'll call it unrestricted dollars, but dollars or net assets without restrictions, and we weren't successful at that. So on the surface, as you look at this, your eyes might draw yourself to the bottom right-hand corner and saying, well, we made $29,152, but in reality, we didn't. We lost a lot of money. We lost a lot of money through this current year transactions. New footnote that you're going to see in this year's financial statements is called a liquidity and availability footnote. A couple of different ways of presenting this. But really what it's getting at is what is the liquidity or availability of the organization to pay its obligations? What resources do we have to pay our current obligations? And this is looking at our, really in essence, a makeup of our current assets and our current liabilities. So on the left-hand side, we have cash at $225,000. We have grants receivable of $450,000. Accounts receivable of $55,000, promises to give, that's current at $15,000 for a total of $745,000 of financial assets. That seems like a lot of money, but what do we have for obligations? Well, included in that $225,000 of cash, we have $160,000 of it that's restricted. Donors have restricted that cash, so we back that off. We have payables of $60,000. We got accrued payroll of $100,000, accrued leave of $70,000, and a little bit of unearned grant revenue. So when it's all said and done, we think we have $745,000 of available resources, and we do, but we have to offset that $745,000 against the current obligations that we have. So in the end, in reality, we have $347,499 of available resources after we pay our current obligations. Still a very positive number, but it's certainly the presentation on the left-hand side shows a little bit different than the presentation on the right-hand side, where we don't include those obligations. You certainly want to have a clear picture of where you're at from a liquidity standpoint on the left-hand side. I think that's much better presentation on our true liquid available resources. Prior approval. Prior approval is something that happens with a number of grant awards. And certainly there are times when we are going to need prior approval. So under any given federal award, the reasonableness and allocability of certain items of cost may be difficult to determine. In order to avoid subsequent disallowance or dispute based on unreasonableness or non-allocability, the non-federal entity may seek written prior approval of the cognizant agency for indirect costs or the federal awarding agency in advance of the occurrence of the special or unusual costs. Prior written approval should include the time frame or scope of the agreement. The absence of prior written approval on any element of cost will not in and of itself affect the reasonableness or the allocability of that element unless prior approval is specifically required for allowability purposes. The point down at the bottom, do not hang your hat on approvals from state or other non-federal funding sources for matters that go against the uniform guidance. What do we mean by that? Well, within the uniform guidance, there is a section called the cost principles. Within the cost principles, it'll go through a variety of costs. And within there, it will tell you if you have these types of costs, whether you need prior approval prior to spending or incurring that cost. For example, property and equipment, it's one that requires prior approval in most situations. So pull out your uniform guidance, look at those cost principles, and look at what costs need prior approval and make sure you obtain that prior approval. Awarding agency's own rules. The federal awarding agency may apply more restrictive requirements to a class of federal awards or non-federal awards entity when approved by the Office of Management and Budget or when required by the federal statutes or regulations, except for the requirements within subpart F of the audit requirements of this part. So a federal awarding agency may apply less restrictive requirements when making fixed amount awards as defined in subpart A. So understand those exceptions and understand that you cannot, as an agency, make something less restrictive. For example, the capitalization policy, there is guidance there where you can set a capitalization policy up to the amount of $5,000. You cannot increase that to $10,000. There's a minimum of $5,000. You can make it more restrictive as an agency if you want. Not sure why you would, but you could. But you could not exceed that $5,000 capitalization threshold amount. Allocable costs, be aware of this. Not all funding sources provide you the same amount of administrative costs or what allocable costs are. Any cost allocable to a federal award may not be charged to other federal awards to overcome fund deficiencies. It would not preclude from shifting costs that are allowable under 2 or more federal awards. So understand what you can charge from an administrative standpoint. Understand that the other programs, you can't, in essence, charge one program when you've incurred it in another. Executive compensation limits. Now, certainly we know the executive 2 level that we have to follow from an employment and training perspective and also a Head Start perspective. The next one is the Head Start. So from an employment and training program, none of the funds appropriate under that public law or prior acts under the heading Employment and Training Administration that are available for the expenditure on or after the date of this enactment in this section shall be used by a recipient or subrecipient of such funds to pay the salary and bonuses of an individual, either as direct or indirect costs, at a rate in excess of executive level 2. So basically, under employment and training programs, you need to follow that executive compensation limit. You need to do the same thing under Head Start law. Now, the employment and training is you cannot exceed that executive level. Head Start will tell you that if you exceed that level, you can't charge anything in terms of Head Start related to that compensation. That is what that slide is saying there. So notwithstanding any other provision of law, no federal funds, and this again is under the Head Start law, may be used to pay any part of the compensation of an individual that is employed by a Head Start agency if their compensation exceeds the level 2 executive schedule. Nepotism. This is the final slide here, and the last thing to keep in mind under the grants administration module. It talks about nepotism and the importance of understanding what nepotism means, and that we have a policy related to it. I'll just read it here real quick. The recipient's personnel policies shall prohibit the hiring of any individual if a member of that individual's immediate family is employed in an administrative capacity in the agency or is a member of the governing board. And then it defines what an immediate family is. It's obviously wife, husband, son, daughter, father, brother, sister, so on. And the term administrative capacity means a position having responsibilities relating to the selection, hiring, or supervising of employees. When a recipient organization cannot adequately staff positions without hiring such an individual, the recipient may deviate from this policy. However, the employment records must provide evidence that no other individual within the service area is qualified and available for employment. That however portion makes this very, very hard to say that somebody in your immediate family member was the only one that had qualifications to perform a particular job. I'm not saying it's impossible. It's just very, very difficult. And the big thing there is you definitely would want to be documenting the heck out of that situation. So basically, as you look at this and you look at nepotism, you want to obviously not employ any immediate family members if you're in that capacity from a governing situation, from an administrative capacity. You definitely want to be aware of that policy and make sure you abide by it. So that's all I had for today. I do appreciate your attention today related to the top 10 fiscal challenges that we see, and it's all a matter of understanding the various challenges that we have. Look at the regulations, look at the documentation, look at the resources that you have. The uniform guidance is a great resource to satisfy a lot of these. Some of the accounting requirements, certainly utilize your auditors, utilize the resources that you have, because challenges are just opportunities masked by something else. So appreciate your time today, and until next time, we'll talk to you later.